how to trade Forex market as an investment bank? Hi, I'm David, and in this video you will learn the correct way to analyze a currency pair, how to select the trade entry by using your subjective probability, and how to cancel your emotions thanks to the value at risk. What I will teach you in this video is exactly how you should trade the Forex market, and that few traders do. What I'm going to tell you has great value. You will hardly find that information in other videos or courses, and surely not for free. It comes from over 25 years of experience in financial markets, even as a fund manager. I tell you immediately that if you are not willing to toil, it's useless for you watching the video. I won't give you the magic formula to get rich just by pressing a button. Do you think I have become a professional trader? That is a person who trades for a living in a day or month? I spent several years to study. I had a hard time, most of all at the beginning. I had to overcome several difficulties before I became the trader I am today. Hard work in trading, like in every field of life, is the basis of success. So, how should you trade the Forex market? First, a mistake most Forex traders make is consider a currency pair as a single market, a price, but a currency pair is not a stock or commodity. Instead, you have to see a currency pair as two opposing economies. For example, you don't have to see Euro, US dollar as a single market, but as the Eurozone economy versus the American economy. Why should you trade Euro, US dollar like Apple or Facebook? On the one hand, you have an individual company, on the other side, two economies. So, get used to consider a currency pair not a single market, a price, but as two opposing economies. Now, you also understand why most traders who use technical analysis are losers. It's certainly not an indicator in the overbought or oversold zone that makes a currency pair rise or fall. After having understood this fundamental aspect of the Forex market, the next step is to buy the strength and sell the weakness. But to do that, you have to compare the two economies. First equation. Strong economy means strong currency, and weak economy means weak currency. So, let's see how you should proceed. First, for each economy, you need to research the macroeconomic data that make the currency market move. And this is the simplest thing to do. Several sites show this data in real time, such as Forex Factory and Investing. You will find the links below in the description. We can divide the main macroeconomic data into four areas: interest rates, growth, gross domestic product, employment, inflation. Then you have to compare and interpret the data to understand for both the economies what the situation is. And this, at least initially, is a little less simple. You have to create two tables, one for each of the economies, and insert the main macroeconomic data. Once you have completed this step, using the data, you need to compare the two economies to figure out which one is stronger. You can also create a graph with Excel for each data, so as to get a more immediate visual image. For example, if the graph of the unemployment rate in the United Kingdom is falling, while that of the United States is moving sideways, even if the American economy remains stronger than the British one, right now it's the British economy that is strengthening over the American one. Second, you have to read the reports of the central banks and listening to the speeches or reading the transcripts of their presidents. These are fundamental to understand the monetary policy implemented by each central bank. Also, you find the situation in the country and often a vision of the world economy. Statements and minutes are therefore essential for understanding the next moves of a central bank concerning interest rates. Second equation. Rising interest rates leads to a stronger currency, and reducing interest rates leads to a weaker currency. The reports and speeches of central bank presidents are essential also because the decisions on interest rates are sometimes known before their release, which means that a decision has already been priced into the market. It's probably a process that may be difficult to implement initially, but believe me that over time you will be able to analyze a currency pair simply and clearly, certainly better than with technical analysis. That was the first pillar of your Forex trading. You have seen how you have to analyze a currency pair. First, you have to see a currency pair not as a market, a price, but as two opposing economies. And then, you have not to use the technical analysis and indicators, but studying and understanding the fundamentals that drive a currency pair. Now, let's see the second pillar. After analyzing a currency pair, you need to select your trade entry. But before, never forget that in the medium to long term, it's the fundamentals that drive a currency pair, but in the short term, it's speculation to do it. For this reason, to buy, for example, euro US dollar, just because your analysis has told you that the currency pair will rise, it's a bad idea. So, how should you decide when to enter? By using subjective probability. I tell you that no strategy can give you the perfect trade entry. It's all about probability. Subjective probability is the numeric measure of chance probability that reflects the degree of a personal belief in the likelihood of an occurrence. Subjective probability judgments are people's evaluations of the probability of uncertain events or outcomes. It contains no formal calculations and only reflects the subject's opinions and the past experience. Now, let's see how to use subjective probability in trading. But before, an advice. Avoid trading with many markets. Focus only on those you know well. Because it's essential to know well the currency pair that is being traded, how it behaves and moves, so you can understand what the key levels are. In this way, you will know which are the price levels with the highest odds of success for your trade entry. Let me give you an example with the currency pair Euro-US dollar. Look at the chart. You will certainly have noticed how the x.xx20 levels, in example 1.0920, 1.1020, 1.1120, 1.1220, and so on, for Euro-US dollar are sensitive price levels. That's just one aspect, a characteristic of Euro-US dollar. Once you understand how the currency pair moves, when you know it perfectly, you will no longer even need to open the chart to decide your trade. To complete this part, I show you the next chart. Here, you can see some significant areas for Euro-US dollar that I identified thanks my knowledge of the currency pair and experience. If, for example, my idea was to sell Euro-US dollar, I would wait for the price to reach one of these areas before opening my trade. Which of them? It depends on various factors, such as, in addition to knowledge of the currency pair, a reading of the current situation and volatility. And what about the take profit? First, you need to know when to take your profit before opening the trade. You have to decide it in your trading plan. Then, it has to be a take profit statistically achievable and have a risk-reward at least 1-to-1. To select your take profit, you have to put into the field all your knowledge of that currency pair, and how you did with the trade entry, use subjective probability. This was the second pillar of your Forex trading. You have seen how to select your entry and exit points in trade. You have to use subjective probability, and thanks to your experience and knowledge of a currency pair, choose the trade entry with the higher odds of success. Now, let's see the third and final pillar. How to select the stop loss and cancel the emotions. It's well known that success in trading is determined by our emotionality. You have to put yourself in the best conditions to trade. The problem with the management of emotions is that we are all different. So, it's impossible to have a system that works for everyone without distinction. To erase your fears, anxieties, before opening your trade, you have to decide how much you are willing to lose with that trade. Then, you have to set the stop loss on equity, that is the value of your trading account, not the price. But where to set the stop loss? You have to use the value at risk. Value at risk measures the potential loss in value of a risky asset or portfolio over a definite period for a given confidence interval. There are three key elements of a value at risk: a specified level of loss in value, a fixed time period over which risk is assessed, 1 day, 1 week, and so on, a confidence interval, usually 95% or 99%. Let's see an example. If the value at risk on Euro US dollar is 1.81% at 1 week, 95% confidence level, there is an only a 5% chance that the value of Euro US dollar will drop more than 1.81% over any given week. So, if you decide to buy Euro US dollar, if you set a stop loss 1.81% away from your entry price, you will have a 95% probability of not seeing it met by the price. At this point, all you have to do is calculate the correct position size to open, based on the maximum loss that you are willing to suffer, and that you must have already decided in your trading plan. That's the way to dispel your doubts about how to set the stop loss, how to cancel your emotions, because using the value at risk, you are working like an investment bank, a fund manager. This was the third and final pillar of your Forex trading. You have seen how to cancel your emotions thanks to the value at risk. Now you have all the information to become a profitable trader in Forex trading, to trade like an investment bank. You can get significant results in Forex trading, maybe even better than mine, but only if you apply what you have seen in this video, and you will work hard. If you want to deepen what I have explained, I have written an ebook where I have put all my knowledge and experience with several examples. You find all the information in the description below. I went back and I want to thank you for the time spent watching this video. I hope what you have seen could help your trading. For everything, you can leave a comment in the section below. The only rule of my channel is good manners. And if you liked what you have seen, then subscribe to the channel by clicking on the icon below to be always updated on the next videos. I thank you again for your attention and I wait for you at the next video. Happy trading to you all!